So imagine you're a bank in Singapore, and you're trying to send, I don't know, $100 million to Europe at 11 p.m. on a Sunday. Right now. You just can't do it.
Right, yeah, the money gets totally trapped. It's basically stuck in this massive financial layover until clearinghouse is open on Monday morning.
Exactly. So today on the deep dive, we've got a pretty fascinating module on the future of money in front of us. We're looking at how central bank digital currencies and, stablecoins are stepping in to replace legacy systems.
Yeah, old rails like SWIFT and correspondent banking, which are just so slow.
Right. Okay, let's unpack this. If moving money globally today is like a grueling, multi-stop flight with endless layovers, then we are basically talking about the invention of the financial direct flight.
And building that direct flight, it really has to start at the top of the financial food chain with wholesale CBDCs.
Which are strictly for the massive financial institutions, right?
Yeah, right. Because banks right now, they rely on correspondent banking. They essentially hold accounts with each other and just constantly message back and forth to update their own separate ledgers.
Oh, so it's like two banks updating completely disjointed spreadsheets instead of just, looking at one live Google Doc.
That's actually a great way to think about it. Wholesale CBDCs migrate all of that onto a single shared digital ledger.
So is this basically a VIP fast pass for banks to just bypass the weekend entirely?
It really is, yeah. Because it allows for something called atomic settlement through smart contracts.
Wait, atomic settlement. What does that actually mean for our $100 million Sunday trade?
It means the smart contract code just locks the funds from both parties and executes the swap simultaneously. Like if one side is short on funds, the whole transaction simply fails to execute.
Oh, so nobody's left hanging mid-trade.
Exactly. Zero counterparty risk. That $100 million exchange completes in about 2 seconds on a Sunday night.
Wow. Okay, so atomic settlement completely fixes trust and speed between the massive institutions, but banks are really just intermediaries for us.
Right.
Does this direct flight technology trickle down to the consumer level? Or do we still have to rely on private commercial banks to, hold our money?
Well, that brings us to retail CBDCs. The fundamental shift here is moving from holding a liability of a private commercial bank to holding a direct liability of the central bank itself.
Just like physical paper cash.
Exactly.
Wait, but isn't the money on my phone's banking app already digital cash? Like, why does that liability shift actually matter to you or me on a random Tuesday?
It's all about resilience and finality. So imagine a massive weather emergency completely knocks out the local cell network.
Oh, right. Your Apple Pay or digital wallet is basically a brick then.
Yeah, it can't ping your bank's servers. But with a retail CBDC, the funds can actually be stored in secure hardware elements right on your phone.
Wait, so you could send money without the internet? How does that even work? They can't talk to the central bank's ledger?
Well, two citizens can just use local Bluetooth or NFC to instantly settle, say, a $50 transfer completely offline. The secure hardware cryptographically verifies that the funds are real.
So it ensures you haven't double spent it locally, and then it just syncs later.
You got it. It automatically syncs with the central ledger the very second either phone gets an internet connection back.
That hardware bridge is brilliant. But let's be real. Governments are notoriously slow at rolling these massive public networks out.
Oh, definitely. And private companies aren't just sitting around waiting for the public sector to finish their beta tests.
Right, which brings us to the private sector. Here's where it gets really interesting, though. I have to push back a bit here.
Sure, go for it.
The crypto industry has repeatedly proven that these so-called audited accounts aren't always as transparent as they claim. How are regulated stablecoins actually different from the Wild West projects?
Honestly, that skepticism is totally warranted.
Right.
But the crucial distinction here is the regulatory framework. The modules we're analyzing focus on entities operating under strict traditional banking-grade audits. We're talking about fully backed digital fiat on private blockchains, tokens pegged one-to-one to the dollar.
And they're backed by actual cash and short-term U.S. Treasury bills, right?
Yes, held in custodian accounts, not offshore wildcat projects. And the competitive threat they pose to legacy revenue models like SWIFT is just immense.
Well, the sheer efficiency is a completely different paradigm. Like, think about a U.S. tech platform that needs to pay 2,000 independent developers globally.
Right. Under the old SWIFT system, every single wire incurs a massive bank fee, a terrible exchange rate cut, and takes days to arrive. Just friction at every single hop.
Exactly. But with stablecoins.
Using regulated stablecoin rails on an enterprise blockchain, that same platform can just automatically disperse those funds.
Wow.
Every developer receives their exact payout in about 3 seconds.
Wow. And what's the transaction cost on that?
Less than a single penny per payout.
Less than a penny. So, what does this all mean for you? Well, these new rails are the invisible plumbing that will soon power your everyday cross-border purchases, remittances, and payroll.
Yeah, and if we connect this to the bigger picture, we're watching the fundamental architecture of money being rewritten to completely remove the middleman.
And it leaves you with a pretty wild scenario to think about. If private stablecoins and sovereign retail CBDCs eventually exist side by side on our phones, will citizens ultimately trust privately managed money over government-issued digital cash? When it comes time to book that direct flight for your money, which airline are you actually going to trust?